employer mandate, and walk us through how to prepare for that. Just a couple housekeeping items. Everybody on the call or that's joining is muted at this point. The reason for that is we're going to go ahead and record this session. It's being recorded right now. After the meeting, actually, you have an opportunity, if you can see it, to ask some questions on your chat. We'll try our best to record those and answer them at the end. And then also feel free to follow up with your account management teams after, and we'll put a collective Q&A together and get that back out to everybody today. So I'm going to go ahead and turn this over now to Kara. She's going to start us off.
Okay, thank you. Good afternoon, everyone. My name is Kara Backus, and I'm sitting here with Tom Kramer, my colleague from Bullard Law. As Brenda explained, we work very closely together with Davidson on all kinds of employee benefits issues. We are both employee benefits attorneys, and in our haste to put this presentation together, we forgot to put our own names on the presentation, so we apologize for that, but that's who we are, and coming to you live from Davidson here. So the presentation that we've prepared for you today is intended to provide an overview of the Employer Shared Responsibility Payment, or ESRP. This is the process for payment of penalties under the Affordable Care Act's employer mandate. So those penalties that are imposed by the IRS with respect to applicable large employers. So that's what we're going to be talking about. All right, so what we're going to do is, oh, I'm sorry, can we go back just to that? So just to kind of give you a quick overview of the agenda, we're going to talk about this employer shared responsibility payment, how the IRS is planning to communicate with employers, and how employers should communicate with the IRS if they receive some sort of letter from the IRS. And then we're going to talk a little bit about how employers can prepare to respond or prepare to receive a letter from the IRS. So right now, I think a few employers have received letters, but a lot of employers are sort of sitting around wondering if they will receive a letter. And so we're going to talk about some of the things that employers might be able to do in anticipation of receiving a letter. And then we're going to just go through some examples and some next steps. Okay, so in early November, the IRS announced that it would begin enforcing the employer mandate before the end of the year with respect to 2015 compliance. So as I just described in the introduction, the IRS will do this by assessing an employer shared responsibility payment. You might remember that back in early 2016, applicable large employers were required to submit information reports to the IRS with respect to their coverage under their plans in 2015. But what's important to know about this current enforcement effort is that you might also remember that in 2015, penalties didn't apply to certain applicable large employers. So penalties for 2015 will only be imposed upon ALEs with 100 or more full-time and full-time equivalent employees. Those are referred to as FTEs. So just another quick reminder, an FTE can be an actual full-time employee, but there's also a process for sort of looking at the rest of your employee pool and sort of counting some of those employees as FTEs so that you have a combination of actual full-time employees and full-time equivalents to get up to that 100 number. Most of you on the call probably know whether or not you are an FTE with 100 plus. But this presentation today is sort of intended for that audience, those employers with FTEs of 100 or more, and we're just kind of focused today on 2015 compliance. Okay. So this is how maybe some of you on the call are feeling about about the fact that the IRS is now actually enforcing this employer mandate that we've been talking about for several years. Okay, so what ALEs do we think are likely to be assessed? If the IRS thinks that you owe a penalty, you will probably receive a letter 226J, and we'll show you that letter in a few minutes. We think that these letters are being generated based on what you reported back at the beginning of 2016 on your forms 1094 and 1095. And so the IRS is going to look over those forms that you provided, and penalties we think will be triggered based on certain inconsistencies in sort of what was reported and what your employees were actually doing, or just employers who reported coverage that didn't comply with the rules. So applicable large employers whose employees went to the healthcare exchange and received a subsidy even though they were full-time employees. Applicable large employers that didn't file their forms 1094 or 1095 on time. Those employers that offered coverage to some full-time employees, or even all of their full-time employees that maybe was unaffordable. So as you know, part of the requirements under the Affordable Care Act are to provide affordable coverage to those employees who are considered full-time, and if you decided to offer coverage but maybe it wasn't affordable, then you might trigger a penalty. And then finally, applicable large employers that didn't offer a minimum essential coverage plan that also provided minimum value to their full-time employees and minimum essential coverage to dependents. So we think that these are the issues that are going to sort of get triggered on the forms 1094 and 1095 and cause the IRS to send out this 226J letter. And if you receive a letter, just know that the response timeline is pretty short. So you're required to respond to the IRS within 30 days of the date that's on the letter. We think you can request an extension, so that gives you a little bit of comfort, but it probably is possible to respond within that 30-day deadline if you get the letter on time. I think the challenge here, and we're going to talk about this a little bit later, but you just want to make sure that you that it doesn't sit on someone's desk for a week or two, because I think it's you know, not totally clear which of your employees might receive the letter, and you just want to make sure that you're kind of on the lookout for that. If you decide to appeal the assessment, you will respond using forms 14764 and 14765. Again, we're going to show you these forms in a few minutes and kind of walk through them and how you use them, but important to know that you need to sort of complete the response in a particular way, so we'll talk about that. But if you don't respond, if you get the letter, or if it accidentally sits on someone's desk over the holidays and then you find that you've missed the 30-day timeline, the IRS is probably going to just automatically assess a penalty. So you want to be sure to respond in one way or the other.
Let's go back and review. This is Tom Kramer, and what those penalties are, because I suspect you all learned about them not long after the ACA was enacted, and if you're like the rest of us, other things intruded on your mind and you kind of forgot about them once you got your ACA compliance or determined non-compliance in place. And so I'm going to refer to these as the A penalty and the B penalty just after the code sections that refer to them. The A penalty is the big penalty, and way back when I called it the sort of inadequate offer penalty, as opposed to the B penalty, which we'll come back and look at on the next slide, and it's the unaffordable coverage penalty, if that helps you to remember what they are. The A penalty applies, as you can see on the slide, if the employer, the applicable large employer, of course, has failed to offer minimum essential coverage, not minimum value or affordable, just minimum essential coverage to at least 95% of its actual full-time employees and their dependents. And so just to review, we're talking only about actual full-time employees here, not the full-time equivalents that Kara talked about earlier that we use to count to see whether an employer was over 50 or over 100 FTEs. And here we're talking also about dependents. Dependents don't include spouses or partners for this purpose. So an employer for example, that doesn't offer minimum essential coverage to employees, spouses, or partners, isn't triggering a penalty for itself for this purpose. You can see in the fine print there's a special rule for 2015. And again, even though here we are at the end of 2017, as Kara pointed out, we're talking about the 2015 year here, not 2016 even, but 2015. So that's how far behind the IRS is. And for 2015, that 95% threshold was reduced to 70%. So employers who offered coverage to a lot of their full-time employees, but not nearly all of them, still could have escaped penalties or this penalty in that year. And then, even though I said above that the general rule is the employer has to offer, in order to escape this penalty, coverage to employees' dependents, there was not a similar rule for some employers for 2015. So if you said, no, we've never offered coverage to employees' dependents, and we'll get there, but we're not going to get there for 2015, that would not subject you to the A penalty in 2015. You couldn't drop dependent coverage. That was why it was a special rule. So if you'd been offering dependent coverage all along and thought, oh, this is a great idea, we'll kick those kids off the plan for 2015 and avoid a penalty, that actually didn't work. Some lawyer thought of it, but it didn't work. Like so many things that lawyers think of. So what was the A penalty? The A penalty, as you can see, was $2,080 a year. It was imposed monthly. So an employer that was in compliance for some months of the year and not for other months of the year would be penalized based on that $173.33 figure per month. But look at what remember what the nasty surprise is, and that is that it applies to every full-time employee, and it applies regardless of whether you offered coverage to those folks. So remember, it was a 70% threshold. If you offered coverage to, let's say, 68%, maybe not just offered coverage, but actually provided coverage to 68% of your full-time employees, you were subject to this A penalty based on all of your full-time employees, even those to whom you offered coverage or provided coverage. You got the initial subtraction. After 2015, it was you could subtract off the first 30 full-time employees, special rule for 2015. You got 50 more. You could subtract off the first 80 full-time employees. We'll come back to this when we look at a particular example, as Kara said later. So that's the A penalty. It's the big penalty because it applies to all of the full-time employees if you miss that 70% threshold after you subtract the first 80 full-time employees. Obviously, it can add up pretty quickly. Now, the B penalty is a smaller, and it's a person-specific penalty. But let's just think about that. Let's imagine that the employer says, look, not only did I offer coverage or provide coverage to at least 70% of my actual full-time employees, I provided coverage to 99% of them. I left only 2 or 3 people out of my full-time employees. In fact, the only group of employees I left out were the legal department. We didn't offer them coverage. We figured they'd be institutionalized anyway. So for those folks, we couldn't be hit with a penalty, right? And of course, the answer is if those folks went to the exchange and bought coverage and qualified for the subsidy, and of course, we hope lawyers are better paid than that, so they wouldn't qualify. But if they went to the exchange and bought coverage and qualified for the subsidy, they would trigger this B penalty. And the B penalty you can see is larger, but it's a per person penalty. So $260 a month for 2015, increased for later years. And it applies for any full-time employee, but just those individuals employees who went to the exchange, bought coverage, and qualified for the subsidy. There is a cap on this B penalty, and that is it couldn't be bigger than the A penalty would have been if the A penalty had applied. And then there was the affordability standard, and that was basically if it didn't exceed 9.56%. That was a slight increase from the original 9.5% of the employee's household income. So a high-paid employee might say, look, they didn't offer me coverage. I went to the exchange. I bought coverage. I had to spend my own money to do it. And the feds might nonetheless say, sorry, it didn't cost you more than 9.56% of your household income, and therefore no subsidy for you and no penalty for the employer with respect to you. So those are the penalties that the IRS is going to be imposing, we think, or say they're going to be imposing with this letter 226J. And so if we look at the next slide, you'll see what that letter 226J is going to look like. Actually, you won't because it's too small. But if you could read it, what it would tell you, if you can read the very fine print at the top, is we think you owe a penalty. It's not just a communication. It's not an inquiry, not a suggestion. It's actually an assessment. The IRS is saying, we think you owe a penalty. And as Kara said, this is your chance to say, using those forms that we'll talk about next, no, we don't, or we admit that we do, or yes, but could we pay it, say, over time, as opposed to having to pay it in a lump sum. And so the letter is actually quite detailed. This is just the first page, I think, of 8, where they say, you know, here's that we think you owe a penalty, and here's how we calculated that. And so they will explain essentially what individuals went to the exchange and bought coverage, and what we reported, as Kara said, on our Form 1094 and 1095, that led the IRS to think that that we, as the applicable large employer, would be subject to a penalty. Again, our examples will look at some responses to that. But so the 226J is an assessment, does start the 30-day period running. And so if you get that, don't think, oh, they're just interested to know about my report. They're assessing you a penalty. That's what they think you're liable for when they issue you that letter. Okay, so if we look at the next slide, you're going to see what we think you're thinking now. And if you're not thinking that, great, then that just means you're ahead of where we are. And you can look over to the next slide, and we'll talk about your response to the IRS. Okay, so your response will come on these 2 forms, the 14764 on the left of your screen and the 14765 on the right of your screen. And those are the forms that you will use, the narrative on 14764, and then the actual data on 14765 to say to the IRS, no, this is actually what happened. So if, for example, we might have filled out our 1094 incorrectly, and again, we'll come back and look at an example of that, the 14765 will provide the correct information to let the IRS know, no, there's no penalty actually due, even though you, the IRS, weren't wrong. It was actually us that was wrong in the way we reported it originally.
Okay, so this is Kara again. So we're just going to talk a little bit about how to complete these forms and sort of what they do. So the forms that you were just looking at that Tom was describing, that form that was on the left is Form 14764. It's titled ESRP Response, and this is just a pretty straightforward form. The employer simply provides some contact information and indicates agreement or disagreement with the assessment. So you say, okay, yes, we screwed up and we didn't provide enough coverage to our employees, so we're just going to pay this penalty. And you can, you know, say, yes, we agree with the assessment, and send in full payment if you would like to. I think most employers are probably more likely to maybe have some disagreement with what the IRS has come up with. So you can say, no, we disagree, we're not going to pay anything at this time. And then you'll have an opportunity on an additional form or to provide additional information about why it is that you disagree. It's also possible to partially disagree. So if you say, yes, we agree that, you know, we owe these penalties with respect to these 10 employees, but with respect to the other employees, we don't think we owe a penalty, that's possible too. So you're just filling out kind of a short form to say what your, you know, in short, what your response is, and whether or not you're planning to pay anything. If you review the IRS letter and the Form 14765, which we're going to talk about next, on that form, the IRS will list some of your employees and some of the information that you provided about those employees. And you might realize in reviewing all this information, we made a mistake when we filed our Forms 1094 and 1095. And I think that's going to be a common issue for employers, is that they'll realize through this process that they made a mistake when they were filling out their forms. And so one important thing to know is that the IRS does not want you to go back now and refile those forms. If you have corrections that you need to make to those forms that were filed way back in 2016 with respect to 2015, you'll do so through this process with Forms 14764 and 14765. So you don't want to refile anything if you realize that you made a mistake.
Here's a quick technical note about those forms that Kara and I encountered. You can find those forms on the IRS's website or through the IRS's website, but something that we've encountered, and I wonder if any of you have as well, is they don't actually come up, the forms don't, if you're using certain browsers, and they do with other browsers. So if you're thinking, yeah, I'd like to fill this out online, you can do that, but in our experience, it works with Internet Explorer, does not work with either Chrome or Firefox. So it may be that that your loathing for Microsoft products, or for that matter, your love for Microsoft products, will be enhanced by this experience of using Explorer and being unable to use, at least in our experience, either Chrome or Firefox.
Right. Okay, so now we're going to talk about Form 14765. So this form, you'll only complete this form if you if you want to contest the assessment that's been issued. And this form is a little bit more complicated because, as Tom said, it kind of gets into the data. So you're actually dealing with month by month analyses of what's gone on with your employees. And the way we think this is going to work is that you'll receive the form and it will be partially completed already by the IRS. So you'll see for each month of the year, all those full-time employees for whom you filed a 1095-C, if those employees went to the exchange and received a subsidy for coverage. And so the IRS will list out all those employees, and then they'll list all the codes for those employees that you included on your Form 1095-C. And so you'll see all that information pre-populated when you receive this form from the IRS. And then if you'd like to contest the assessment, you'll be responsible for going through and making any changes or corrections to those codes. So as we were just describing, you know, if you are in a situation where you realize that you've made a mistake, and we're gonna walk through an example that I think will sort of illustrate how this might work. But if you realize that the codes that you entered on your Forms 1094 and 1095, or it will be the 1095-C, were incorrect, you can go back and say to the IRS, okay, actually what we meant to say was this other code. So maybe someone was in a limited non-assessment period, or maybe someone was not employed in a particular month when you had them listed on your Form 1095-C. So you'll have an opportunity to kind of go back and compare what information the IRS has about your employees and then confirm whether or not that is actually accurate. You'll also have an opportunity to submit additional information. So there's a little checkbox on the Form 14765, and you can indicate that you are attaching additional information with respect to those employees. And I think in many cases you might also have additional information regarding other employees who aren't necessarily listed on the form. So I think it's a good idea to, if you realize that you've made, for example, a reporting error with respect to a whole bunch of employees, but only 20 employees are showing up on this form, I think it would be a good idea to attach additional documentation explaining to the IRS that not only are these employees miscoded, but we also have other employees that we reported about who were also miscoded. So you can attach all that information and send it all in at once. So if you do respond to the IRS and you're contesting the assessment, they will review your reasoning and look at your updated information, and then they will issue an updated determination. So then they'll send that back to you, and you can see if you then agree with what they've come up with. If you still disagree at that point, then you can request an actual conference with the IRS Office of Appeals. So that will generally happen within 30 days. And then that will hopefully be your avenue to sort of, you know, perhaps negotiate with the IRS about what's happened with your group of employees. And obviously, if you get to this stage, there's a bit of a miscommunication or a disagreement between you and the IRS about what exactly has gone on with these employees. And so you'll have an opportunity to actually talk with someone. But remember that if the IRS doesn't receive any response from you, they're just going to issue a bill. They're just going to send you a demand for payment. So that's the actual tax bill. So, you know, it's a good idea to respond in a timely manner and make sure that you are communicating with the IRS. After the notice is issued, we don't think it will be very easy to go back and get the IRS to re-engage with you. All right, so hopefully you're getting a handle on these things. You're looking a little more aggressive at this point.
So what can you do to prepare? And you can see what we've said is it probably starts with communicating with the folks on your team, whether those are people who work for you or people to whom you report, so that they're prepared for this to happen. As you can imagine, if you're the CFO, you don't like surprises. And if you report to the CFO, you know that she or he doesn't like surprises. So you're warning them that those penalties that you may have told them about back in 2015 when you didn't provide coverage are now likely to be chickens coming home to roost. So that they know about them. And you're also talking to your team about the need to respond timely. Remember, Kara said that letter, you have only 30 days to respond, and that letter might go anywhere. It might be sent to even to your vendor, or it might be sent to someone on your staff, or it might be sent to the agent for service of process listed on the Secretary of State's website. You want as many people as possible to know this might be coming as a 30-day deadline. You want them to ship it to you or to the person you designate immediately upon receiving it. So that's part of preparing. The other part is this, and that is being ready to respond in the ways that Kara described, so that you have, of course, copies of what you originally submitted available. Because remember, the IRS is going on two different sources of evidence: what you already reported, and you want to know what you reported so that you're prepared either to correct it or substantiate it. And the other source is what your employees reported, and maybe what they reported wasn't accurate. And again, you want to look back at what you reported to the IRS about those individuals. So somebody went to the exchange and said, oh yeah, I wasn't offered coverage, or that coverage wasn't affordable. They were going to charge me $300 a month. And you know for a fact that you were charging people $90 a month. You want to have that available, and you want to make a look. You want to look back at your 1095-C, that employee, to see if you coded that an affordable offer of coverage for each of those months that that person was treated as a full-time employee. And this is a good time, as you can see in that last bullet on the slide, to think about how you document your offers of coverage. Do you have a process? Signed waivers are good if you can get the signed waivers. But remember, if you don't have the time or personnel to follow up on people who don't submit the waivers, then what you've done is created evidence that you didn't get a waiver and you nonetheless didn't provide coverage. So if you're not going to follow up with respect to waivers, establish your process, document when and how and by what means you sent out those enrollment forms, so that at least you can say we followed our process, and if the person didn't get them, they were the only one of our fill in the blank, 100, 200, 3,000 employees who claims they didn't get them. That's always possible, but it's not particularly likely. Okay. So we know you're feeling better now, and so we think it's reasonably safe. We say that because we're actually in the room with nice people, and you could be just furious out there. It's one of the few benefits of webinars when you can't see us, that we can take some examples. Let's go to the first example. It's a small, applicable large employer. Greg's Grocery had 5 managers, 35 full-time and 20 half-time rank-and-file employees. So you can see it is an applicable large employer because they had, in fact, 50, in fact, in this case, exactly 50 full-time equivalent employers. They did offer minimum essential coverage, and it did provide minimum value to all full-time employees and their dependents in 2015, but it was affordable only for the managers, not for the rank-and-file employees. They had to pay more than one of the safe harbors that would have allowed us to say we offered affordable minimum value coverage to all of our employees. And so this GG, Greg's Grocery, got a letter in our example saying, we think you owe a penalty because there were 10 of your actual full-time rank-and-file employees who came to the exchange, bought coverage, and qualified for the penalty, the credit. And for that was for all 12 months of the year. And so the penalty was that annual $3,120 times the 10 employees for a $31,200 penalty. And you who are already peeking at the next slide, I know you're doing that. You're peeking at the next slide because we can't see you. You know that they're going to get out of that penalty because they promptly complete the form. It didn't sit on someone's desk for too long a time. And they said, look, we didn't have 100 full-time equivalent employees. And remember that special rule that Kara announced? She said, even though you're an applicable large employer and you had to file forms for 2015, you were exempt from penalties for 2015. And so that's what Greg's Grocery will respond and say, no penalty for us, even though we offered unaffordable coverage and 10 of our full-time employees came to the exchange, bought coverage, and qualified for credits. So you did very well on that one. You can feel good about it. This is a picture of you, actually, not of us in this room. We know you're feeling kind of smug. So let's go to a second example and look at Phase Furniture. And so Phase Furniture had a manufacturing plant with 100 full-time employees, and they also had a retail store where they sort of served as an outlet for their manufacturing plant, and they had 10 full-time employees at the retail store. At the plant, they offered affordable minimum value coverage to their employees and to their dependents in 2015, but they didn't offer any coverage to the retail store. The retail store employees basically were on their own. So they got a letter 226J from the IRS saying 5 of your retail store employees came to us, they bought coverage, and they qualified for a credit, and so you're liable for that penalty of $15,600. Again, 12 months times the 5 people. And what does Phase Furniture do? And if they've done the things that we suggested, they've already communicated up the chain to say, look, these are the chickens coming home to roost. We expected that we would get a penalty. We got a penalty with respect to 5 people, not all 10 of the retail store employees, but we're liable for the assessment. But here are the bonus questions. So remember, we saw that picture of you earlier where you were looking kind of smug. So we wanted to make it a little harder and say, why didn't they get hit with an A penalty? Why didn't they get hit with the A penalty? They didn't offer coverage to 95% of their employees. And so, because they left 10 out of the 110. And what you're thinking, I know you're thinking this, is it wasn't 95% for 2015, it was just 70%. So no A penalty for them. Remember, if they had got hit with an A penalty, it would have been calculated based on their 110 employees minus the first 80. So it would have been 30 people multiplied by the lower amount. But again, no A penalty actually was imposed on them, or were they subject to one. The reason was because even though they failed to meet the 95% threshold, they met the 70% threshold.
All right, so are you hanging on? Starting to look a little less certain now. Okay, so now we're going to talk about Hanks Hardware. Hanks Hardware had 300 employees total. 200 of those employees were full-time. And in 2015, Hanks Hardware, HH, offered MEC that was affordable and provided minimum value to all 200 of those full-time employees and their dependents. So, you know, they felt like they were doing all this stuff right. But then they received a letter from the IRS, letter 226J, along with form 14765 that listed 12 of the part-time employees who had obtained a premium tax credit through the exchange. So the IRS assessed a penalty, this is the A penalty, of $457,600. So you can see how quickly these penalties can add up, especially under the A penalty. And this is with respect to all 300 employees minus that initial 80, because as we've been talking about in 2015, you have that sort of little bit of wiggle room of 80 employees, but still a very large penalty. Okay, so Hanks Hardware, then they review the form 14765, they look at all the data from the IRS, and they realize, back in 2016, when we were thinking about our 2015 coverage, we completed forms 1095-C for everyone, not just for our full-time employees. So they see that they have a problem, and the IRS thinks that they actually have 300 full-time employees. So what do? They complete the 14764, they say we disagree, and on 14765, they indicate disagreement with respect to all of those individual part-time employees that were listed on the form, and then they attach additional information explaining the reporting error with respect to all of the part-time employees that were affected. And so hopefully that would result in elimination of that penalty. This is the employer that realizes that it accidentally filed 1095-Cs for all of its employees instead of just the full-time employees. Okay, this is our final example, example 4. We have Juanita's Jacket Co., 500 employees, and 300 of those were full-time in 2015. 200 were variable hour, for whom Juanita's Jacket Co. used the look-back measurement method to determine their full-time status. So at the beginning of 2015, they were only covering 300 employees under their plan. The company offered MEC that was affordable and provided minimum value to the 300 full-time employees. And then starting in July of 2015, they've been using the look-back measurement method, and they complete that period and they realize that 150 of their variable hour employees have earned full-time status and should now be covered under the plan. So they start covering all those employees in July of 2015 because they've now met those requirements under the employer mandate. But then JJ receives a letter from the IRS 226J with Form 14765, and it lists 24 variable hour employees who had obtained a premium tax credit through the exchange for the first 6 months of 2015. So sure enough, while those variable hour employees were not eligible for JJ's plan, they went to the exchange and received premium tax credit. So the IRS assesses another big penalty. This is another A penalty, $384,800 for the 450 employees. So presumably this is the 300 full-time employees and the 150 variable hour employees who became full-time employees at some point during the year. So the IRS is saying you have 450 full-time employees. We're going to assess you the $2,080 per employee, and then remember you have that margin of error of 80 employees. And this one is also taking into account just the first half of the year. So the IRS sees that the company provided coverage for the second half of the year, but they're assessing penalties for the first 6 months of the year here. Okay, so then Juanita's Jacket Co. goes back and reviews the form 14765, and they see that what they did was improperly code those 150 variable hour employees for the first 6 months of the year. So what they should have done for the first 6 months of the year was to use code 1H, showing that they were not offering coverage for the first half of the year, but then on line 16, they should have used code D, meaning that the employees in a limited non-assessment period. So this is kind of, I understand this is getting into the weeds of these codes, but this might be what you kind of need to do if you realize that you had a coding error on your 1095C, and then the IRS comes back and says, this is what you told us, and then you realize, okay, we need to kind of look at these closely and see what codes we should have entered. So here, in this case, the employer forgot to indicate that the employee was in a limited non-assessment period. What that means in this case is that the employee was still in the look-back period, and the employer didn't have an obligation to provide coverage to that employee, that group of employees, because those employees were still being measured to see if they would actually meet the qualifications for a full-time status. So what does JJ do? They complete the forms 14764, indicating their disagreement with the assessment, and then on 14765, they would recode all those employees. So if you look closely, I know that we didn't give you a good opportunity to look at the form 14765. If you look closely at it, you'll see that every month is split into two. So there's a horizontal line between each month for each employee, and on the top, the IRS lists what you presented to them on your 1095C, and then underneath it should be blank, and that will give you an opportunity to make corrections. So you'll see what you entered on your 1095C back in the beginning of 2016 for 2015 coverage, and now you'll be able to correct it if any of those are wrong. And so here you would change that coding to 1H/2D. And then you would also probably attach additional information explaining the reporting error and what happened with all of those variable hour employees who became eligible for coverage in the second half of the year. So that wraps up our examples. Hopefully that helps to kind of give some idea of how this is going to work. And so for next steps, I think we've talked about a lot of these already, but just as a kind of very quick wrap up, you want to just prepare for the possibility of receiving a letter. We don't think very many employers have received letters yet. Some have. but the IRS indicated that they would be sending letters out before the end of the year. And so especially at this busy time of year when people are taking vacation, you just want to make sure that you communicate with your team to make sure that everybody is aware that this letter might come. I think it's also a good idea to just review the samples of the letters, the 226J from the IRS and the forms 14764 and 14765, so you feel comfortable with those forms when it comes time, if it comes time to fill them out and send them back to the IRS. And then as Tom talked about, we think it's important to just gather up all of your documents related to 2015. So all of your forms 1095C, your forms 1094C, and any sort of communications you had with your employees about coverage and your records of coverage for that period. And then if you do respond to the IRS, it's obviously a good idea to just keep records of all of that documentation, because that could come in handy if the IRS comes back around, or if an employee comes back around because they're being assessed a penalty for 2015. So that wraps up our presentation. I know this stuff gets a little bit technical, but we're here to answer questions if you have any. So we're going to open it up now to questions. I believe that you can just type a question in if you have one, and we're here waiting to answer any questions that you have.
We don't see any typing activity going on right now. Are we feeling comfortable just unmuting and seeing if we've got a few questions out there, just real quick, since we have some time?
Yeah.
Okay. So we're going to go ahead and unmute everybody, and if you have a question, go ahead and ask it. And if you could give us the name, or your name, excuse me, and the company you're with before you ask the question, that would be great.
Hi, my name is Elisa, and I'm with Avmere Health Services. I had a question in regards to the penalties. So we're an ALE we have an ALE group, and so we have, I think, 45 different ALEs. And so when these penalties are assessed, the calculation that goes into the penalties, is that per ALE, or is that going to be our company as a whole?
Oh, good question. And we're just going to talk for a while in the hope that you'll forget what you asked, because it's such a good question and a hard one to answer well. So I'll start talking and then see if you've forgotten or lost interest maybe. No, you're absolutely right. The premise of your question is the ALE members are all viewed separately. And so they should be assessed separately. They each get a pro rata share of that 80 employee subtraction for purposes of the A penalty. And they're subject to the B penalty for their own employees and not for others generally. So there ought to be separate letters 226J for each of the ALE members, assuming each of the ALE members, as they should have done, filed separate Form 1094 and 1095C.
Okay, great. Thank you.
Good question.
Can we get a copy of this webinar?
Yeah, yes, we'll forward out a copy to everybody that we sent out the invitation to, and your benefit consultants will also have a copy. It looks like we need people to click chat at the bottom of the black screen. So that what, if you have a question.
Hey, you get the free monkey pictures too if you request a copy of the webinar.
Is there any more questions from anybody? Not right now. Tom and Kara, thank you so much for your time and being here with us to present and talk us through with our clients. I know we expect the IRS is coming for us, so we want to be ready for it. So.
Thank you all.
All right.
Yeah,
Thank you very much. Thank you, everybody,
Thanks for having
for
us.
joining us.